is everything.
This is Bloomberg Markets. At the top of the next hour, the U.S. government will sell $16 billion of 10-year inflation-protected Treasury notes. Now, inflation may have moderated from a year ago, but not quite enough to convince the Federal Reserve to start cutting interest rates. So let's discuss what demand and returns look like with Amerant Investments CIO Baylor Lancaster Samuel. Baylor, it's so good to speak with you.
Thank you so much. Thanks for having me on.
So I want to start with today's flash PMI data. We got some reads on manufacturing and services and the composite, and all three were hotter than expected. It showed the economy doing better than what economists had anticipated. And we see U.S. bond yields spiking across the curve. Is that reaction justified, do you think?
Look, I think we're in a range right now between 4 and 5% on the 10-year. We've seen, as we came into the beginning of 2023, the 10-year was at 3.8%. We thought that was a little bit snug. At the time, we said too fast, too furious on the bond markets rally. So now we've retraced that back. Here we are at 4.5 today. And I would say that, every little tick of the bond market, people like to focus on it. But what we're saying is that you're in a range here. We don't think you're going to get much higher than 5, and you're going to stay between 4 and 5 for the foreseeable future with the Fed on hold. Right.
Well, I appreciate your being able to zoom out and give some context here to what seems like sizable moves, at least on a daily basis. What kind of reaction do you think the TIPS auction today will give us when it comes to investor demand for fixed income with the current inflation situation as you see it?
Thanks for that question. What I would say about TIPS auction is that we're at 2.35% on break-even level. Again, if you think over time, the CPI has been around 2.5% over the long term since 1995. So 2.35, you would want to be in the TIPS if you think inflation is going to be a little bit higher than that over the next 10 years. That's your break even. I think there is a risk that we do see CPI higher than 2.35, but it's not terribly cheap here. It may be a little bit cheap on a relative value basis. Certainly in the pandemic, we saw break evens plummet to as low as 50 basis points, and that was when TIPS were a screaming buy. I think now you could say that's maybe a little bit cheap, but not hugely out of line with long-term trends.
Got it. And of course, this week there was not just this morning's data, but also the Fed minutes, which moved markets, which is kind of unusual because Fed minutes don't usually move markets. But I want to get your takeaway from those minutes because a lot of people read it as very hawkish. I wonder from where you sit, did it leave every option on the table, including the possibility of rate hikes if inflation doesn't behave?
You know what? I did read the minutes last night, and I agree that those came across a little more hawkish than expected. There was a statement in the minutes that said various participants have a willingness to tighten policy further should risk to inflation materialize. So, what's going on? I think in the press conference, Chair Powell took away the likelihood of the next move being a hike. He clearly said that was unlikely, and the minutes put it right back on in. So, that's the kind of language that would lead you to think that we could have a hike in the future. My expectation is that the Fed is on hold for the foreseeable future. So I think that's a bit of a hedging statement. I do believe that the next move is going to be down from the Fed, but they do want to put that back out there as sort of a threat to the markets because we are in very loose financial conditions right now and sort of reaccelerating the economy as you saw today with the PMIs.
Yeah, and as you see with the meme stocks, the resurgence of that in recent days as well. So put that all together. What kind of conversations are you having with your clients then, especially when it comes to their appetite for treasuries?
That's a great question. I think what we have right now is that we have a challenge to communicate with the clients that it's okay to take a little duration here. We do think we're range bound. And we're building corporate bond portfolios with over 6% yield with an average investment grade rating. And if you look over time, we think that's perfectly good place to be for the clients that can hold those bonds to maturity, even if there is a little bit of rate volatility here in the next year or so. The conversation is a challenge, however, because, of course, the curve is inverted. And so there is a tendency to do the T-bill and chill, as everyone likes to call it, stay short and not take a little duration risk. We think that's a mistake. We do believe that over time, the long-term neutral rate is lower than the current Fed funds rate, and you will be rewarded for having that duration.
Got it, got it. You know, T-bill and chill, everyone likes sitting there and just generating some income without doing a whole lot and certainly not taking any risk. With rates where they are, people have gotten used to 5% plus returns and not doing anything. So I wonder how that has affected their investment preferences, the products they choose, the expectations they have overall. Because you look at the ETF space, for instance, and every new launch has the word income in its description.
Well, I would say that, you know, we're back in a world where fixed income provides income, but it's hard for people to sort of get away from that mentality that we had where fixed income was sort of in the wilderness for 14 years. I looked this morning, the 10-year Treasury touched 4% in 2010, and it didn't get back there till 2022. So for 12 years, we had 10-year below 4%. Now we're at 4.5%. So I think it has to be in the right context here and sort of re-educate people that you can take duration risk, and especially if you think the next Fed move is going to be down, which we do, then you want to be moving out the curve before that happens.
Yeah, it's a new normal, in other words. Amerant Investments
That's right.
CIO Baylor Lancaster. Samuel, thank you so much. Great speaking with you.